the market is interesting today for many reasons. But the reason why we find it interesting today, especially the credit space, is because unlike the widening that we've seen in the previous crisis, say 2008 crisis or COVID crisis, there was a significant uncertainty about how the default and credit events are likely to play out. What is the recovery going to be for many of these assets? And the spread and the returns that investors was obtaining on these investments were the right reflection of what they were taking as a risk in these spaces. Today it's different. It's different because the credit spread is a result of the volatility to a certain extent. But more importantly, there are three prongs which actually causes the widening and the yield that investors see today. The first one is the interest rate volatility. The unprecedented hikes of the interest rate across the globe, including Europe and US, UK as well, from close to 0 to 5%, 5.5% in the US, has given rise to uncertainty as to where the rates are likely to be in the next 12 to 18-month period. And investors who invest in credit are usually going through fixed rate instruments, and they tend to want to get compensated for that all risk that they're likely to take in these credit spreads, especially the IT. The second prong arrives from the uncertainty of the default environment. Many economists have said that over the period of next 2 to 3 years, the cumulative default might go as high as double digits on the speculative grade credit. S&P have published the next 12-month forecast to be around 4.5% default in this space as well. Our view is significantly different. We believe that credit is going to remain muted over the period of the next 12 to 18 months. We might see more restructurings coming up, more credit solutions being popped up, but dramatic defaults, jump to default is a scenario that is less likely to occur over a period of time than what we've seen in the past.
So against that factor, why are we not scared about default rates going up as much as some economists and rating agencies predict? Arguably, the central banks have reached the end of their hiking cycle, or are relatively close to the end. And with a floating rate debt, you can already see the effect on borrowers. Sure, there's more to come from the fixed rate component of the debt. And simple math shows that every percentage point in increase in the interest rate cost the borrowers roughly $3 trillion. So why are we not worried? Well, the main reason is that a large part of that kind of new leverage and new debt has gone or has been risen by the government sector. And if you look at the corporate sector and the household sector in particular, the debt has gone up, but the leverage has not gone up as much, or actually very little, if you look at the debt to GDP ratio. So household balance sheets have been very stable, very resilient. And this is why we have not seen a massive increase in default rates in that sector. Sure, delinquencies have gone up. Yet default rates in the corporate world will go up. But we are rather constructive on how this will play out once the rate increases fully have comes through the market and everything has been refinanced or reset.